Good evening. Real estate, and in particular Custodian Property Income REIT. Over the next 20 minutes, I'll try and give you a flavour of Custodian, explain why we buy smaller regional property, and give you my view of how you should consider worth as opposed to value. So we have a market cap of 415 million. We've been trading since 2014. We are a proudly diversified fund. And being diversified hasn't been very fashionable over the last few years. But as you can probably tell by looking at me, I've never really followed fashion, and I think style is more important. And I probably failed there as well. But nevertheless, that diversified style, spreading risk, mitigating risk, we think is really important. And, last year we saw some of the sector-specific real estate investment trusts see a negative share price total return of 45%. On average, the UK real estate, listed real estate market share price total return last year was negative 34%. Custodian REIT, negative 2%. Now, I know that's still not positive, but I think it's fair enough in the circumstances we're in last year to look at relative returns. And that relative outperformance came from a diversified strategy and a strongly income-focused strategy. I'll talk a little bit more about why smaller regional properties in a little while. Income absolutely central. Income comes from earnings of 5.6 pence, fully covering a 5.5p dividend, and that fully covered dividend we think is sacrosanct. Gearing is currently around target at 27.4%. So let's consider worth and value. Now, we've heard a lot this evening about net asset value. I think net asset value in real estate is a perfectly rubbish measure of worth. It's what somebody thought the properties were worth 3 months ago. But what does that mean to shareholders? What's more important is earnings. 75 to 80% of total return from real estate comes from income. So it makes sense to us to have a strongly income-focused strategy. What this chart is showing you is what net asset value did, in the blue line, last year. And you can see in the early part of the year, valuations got carried away and then fell back sharply in the autumn of last year when interest rates started to rise. Well, the red line is showing you is the earnings per share, and the grey line, the share price. And you can see that shareholders in Custodian REIT have clearly taken the medicine and understood that it's not about net asset value, because you can see that share price, okay, it's a little bit of volatility, but has stuck much more closely to an earnings metric than it has chasing net asset value. And you can see at the start of 2021, so March 21, earnings yield of 6.1 and 6% today. So that's been pretty consistent. And I would counsel anyone looking at real estate to focus on earnings, not on net asset value. And we can learn from the US, which is a much more developed real estate investment trust market than the UK, where if you look at their quarterly trading updates, you won't even find a reference to net asset value. It's all about earnings per share. But you've got to look a little bit deeper. It's not just about the earnings. You've got to look at the underlying real estate and where is the growth going to come from. I'm happy to say that increasingly investment trusts, real estate investment trusts, are starting to publish equivalent yields. The equivalent yield in real estate is effectively a weighted average between the net initial yield, so the rent divided by the value, and the reversionary yield, so the expected rental growth. And where the equivalent yield, I'm teaching you to suck eggs, but forgive me, I've started, so I'll finish. Where the equivalent yield is ahead of the initial yield, that implies there is rental growth to come. And you can see there is rental growth across pretty much all of the portfolio, with the exception of high street retail. However, even in high street retail, we're starting to see after 5 or 6 years of falling values, we're starting to see some rental growth in prime high street locations. Picking off the other sectors, retail warehousing, so this is out-of-town retail. The bit that we focus on is retail warehousing let off low rents, typically occupiers, like DIY, homewares, food, the discounters. They all operate paying relatively low rents, sort of £10 or £12 a square foot, and they are highly affordable for those sort of occupiers. Vacancy levels are low, and we're starting to see the beginnings of rental growth there. In the office sector, strangely, you might think, with hybrid working and people deserting their offices in droves, there is in fact rental growth. But it's very specific. The sort of offices that are attracting rental growth in following the great working from home experiment that we all endured through lockdown. And I say endured because actually an awful lot of people are really glad to get back to the office. They might not be getting back to the office 5 days a week, but the Victorians would be shocked that we only go in 5 days, not 6 days a week. So the fact that people now go in 3 perhaps shouldn't be a huge surprise. But the sort of offices that are in demand and are commanding premium rents are buildings where, as a landlord, you provided a much higher level of amenity than has ever been provided before. In the past, you typically let offices with grey carpets. They used to be blue, now they're grey, white walls, and you'd say to the tenants, go for your life, you fit it out, your problem. It's not good enough now. As a landlord, you have to put an awful lot more amenity into buildings. If it's a simple stuff like showers and bike racks, but it could be yoga studios and coffee bars. It doesn't really matter. It's whatever the tenants want. And where you provide those sort of buildings, there is rental growth. And the real showstopper is the industrial and logistics sector. And we are the smaller end of that market. There is real rental growth there. If you take a typical town across the UK, industrial rents are £5 a square foot. If you're going to build new space, you need to charge a rent of £10 a square foot. Otherwise, it's not cost effective to build. So that's putting real pressure on existing buildings. So those refurbished existing buildings, excuse me, rents might be £7.50 to £10, brand new space, £10 a square foot. So real rental growth, that's the powerhouse. And rental growth is the headline in real estate that never gets written. People are far too busy writing stories about law firms taking 100,000 square foot of offices in the city. In all markets, and particularly in this one, balance sheet strength of a real estate investment trust is what you should look at next after you've considered earnings, future earnings, and growth potential. I'm happy to say that Custodian Property Income REIT has always taken a very conservative approach to debt. You can see on the chart, excuse me, we've got 4 tranches of debt, 3 of them fixed for the relatively long term and a shorter term revolving credit facility. What does that mean? It gives us a weighted average cost of debt of 3.7% and a weighted average maturity of debt of 6 years. Now that's 3.7% against a portfolio with an equivalent yield of 7%. You can see that that debt is strongly accretive to earnings. This chart, putting everything I've just said together, shows the relative outperformance of Custodian, showed by the light blue line, against our close peers of diversified UK real estate investment trusts since April 22. Where does that outperformance come from? I think it comes from a very honest discussion about what we're about, and we are about income first, and I think our shareholders understand that. It comes from a broadly diversified strategy and our regional smaller properties. And this is the bit you've been waiting for, and this is the bit. If you remember nothing else, please remember this. Why do we buy smaller lot-sized regional property? I'm going to explain it by looking at this chart. What this chart looks at is whole market data going back to 2000. It looks at the net initial yield of properties traded in the market with a lot size of less than 10 million, that's the dark blue line, and greater than 10 million, the light blue line. And you can see for the first 10 years, there was a pretty narrow and consistent margin of about 75 basis points. Let's call that the risk premium. Now, I would argue that it's not all risk premium. An awful lot of that is just hassle factor. People can't be bothered to manage a large portfolio of small properties if they could just manage a small portfolio of larger ones. I'm sure I said that the wrong way around, but you know what I mean. Let's call it the risk premium, 75 basis point risk premium. So what happened in 2010 to see this divergence? Was it a change in the risk profile of smaller properties versus large? No, absolutely not. This was a change in supply and demand dynamics. Back into the market in 2010 came the property unit trusts, the open-ended funds, the villains of the piece. UK pension funds were upweighting to real estate, and we saw overseas money, both in private equity and sovereign wealth funds, coming into the market. And they all pursuing a relatively similar strategy of large prime assets, and that pushed prices up, yields down. At the same time, a lot of these same funds were selling down their smaller properties. So we saw this huge divergence, which has given us a very consistent 150 basis point margin. Yet the risk premium is only 75 basis points. So I would argue that we are getting 75 basis out of that 150 basis point margin for taking no additional risk. And that allows us to pay a higher dividend, fully covered, and I think has driven our outperformance. When it comes to diversification, we've got 165 properties with a market cap of 415 million, over 300 tenancies, such that we have no one property in the portfolio let to a single tenant that accounts for more than 1.5% of the rent roll. So genuine diversification. Even if you look at our top 10 tenants who account for 22% of the income, that's spread across 28 properties. So further diversification, even in and amongst the properties we have. One of the challenges that has often laid at my door, saying you've got smaller properties, these are not corner shops, they are not workshops under the arches. These are good quality buildings, and we don't feel you need to sacrifice the quality of the building, location, or indeed the tenant. And if you look at the Experian credit rating of our tenants, you can see here that about 75% are low risk and nearly 90% lower than average risk. And actually, if you come all the way down the chart to the slightly cruel moniker of imminently failing, actually this is where we see opportunity. Because there's all too often those tenants who have been imminently failing, that the best thing that can happen is when they actually fail. And we get our chance to get hold of the property, refurbish it, and pick up the value growth that has been held back by having an imminently failing tenant in the property. Which I suppose leads us to asset management. This is something we do in-house. We collect all our own rent. And it's a 365-day-a-year performance. There is always something to look at. And time was that we would have, going back 7 years, we would have had a property strategy and we would have had an environmental strategy. Those two have come almost seamlessly together now. But we're still encouraged to explain them separately, and I think that's slightly muddled. We now manage our portfolio in the full glare of Greta Thunberg and Sir David Attenborough. And we know that we have a moral responsibility, there is legislative pressure, but more importantly, there's a real economic advantage to us and to shareholders of managing our properties and refurbishing our properties to the highest possible environmental standards, because we get higher rents, we let the properties to better quality tenants, and we let them faster. And all of that's good for cash flow, it's good for earnings, drives that dividend growth. So a couple of quick examples. As the clock rudely says to me in red, I have 1 minute. That's fine, that's all I need. Examples of asset management. Here was an imminently failing tenant, Pizza Hut in Leicester. They put the business into CVA. Why they didn't trade as a takeaway through lockdown, I don't know, but they chose not to. Put it into company voluntary arrangement. We don't like that. We don't like tenants that don't respect the landlord and tenant relationship. So we exercised our right to repossess the unit, and we have refurbished it. That is a refurbished building you can see on the right of this one, not a knockdown and rebuild, but a refurbishment. We've added a drive-through lane, let it to Tim Hortons, and for a £200,000 capex expenditure, we've doubled the value of the property. And at the slightly larger end of the scale, here was a building on the left in Redditch. We'd owned it for some time, enjoyed good cash flow from it, and we could have continued to let it, but probably we wouldn't have got more than about £5 a square foot. We've knocked it down. We're building the building you can see on the right, and we're forecasting a profit on that of £2 million. And it will also be BREEAM Excellent rating. That means an EPC of an A. Now, we thought we'd get £8.25 a square foot when we committed to this development. We're now looking like we're going to get more like £11 a square foot. Just shows you how quickly, just in the course of 18 months, rents have grown. So to conclude, values in the UK market have stabilised, but you're not interested in the values because you've understood what I've said. You know that net asset value isn't important. Rents are growing. That's the important bit, because if rents grow, dividends can grow, and your returns will grow with them. We believe in refurbishing the assets we've got, improving them to maximise cash flow, and we think that the fully covered dividend from that low-risk cash flow will continue to deliver strong returns. So I now have 9 minutes for questions.
Okay, do we have any questions for Richard, please? I've got a first one then. You mentioned the villains of the piece earlier on, the open-ended funds. For those who are less familiar with the perils or the pros and cons of owning property in a closed and open-ended structure, can you just talk about what has happened there and now what the situation, and how that then affects how that affects you, if at all, now?
Yeah, it's one of my favourite soapbox moments, so I shall condense my bile and venom into the open-ended funds promise liquidity and daily trading, but when it comes to it and you really want that liquidity, it's not there because everyone rushes for the door at once. They own real assets. Well, at least they own 75% of the fund in real assets. The rest of your money that they hold and take fees on is sitting in cash. And they hold fundamentally illiquid assets, so they can't realise those assets when people really need them. So as a fund manager, you're actually a liquidity manager. You spend your whole life managing liquidity. You're only 75% invested in real estate, so your returns reflect that. In a real estate investment trust with 25% gearing, you're 125% invested in real estate. And liquidity is not my problem as a manager. It's the problem. It's a market problem. So share price goes up and down to deal with liquidity. That's why they're villains.
Questions for Richard? Gentleman here first. Let's start here. We'll come back to you second.
A very good presentation. Could you tell me what the average life cycle of one of your rents is and where that stands at the moment? You know, is it 1 year and they're all gone, or 10 years, or whatever?
Yes,
I'm not probably expressing that very well. And secondly, what percentage of your portfolio is not actually rented out at this point in time?
So the weighted average unexpired lease term to first break, which I think the question you've asked, is just over 5 years. And that's sort of what you'd expect for a developed portfolio on the basis that typically we're going to be letting properties for 5 years, maybe 10 years with a break at year 5. So somewhere between 3 to 6 years is where you would expect it to be. But I would say don't focus on the average unexpired lease term because we've got over 300 tenants. They're turning over all the time, except they're not, because more often than not they stay. So the expiry of a lease is just a moment in time, and very often it's an opportunity for us to reset the rent. So sometimes we see that as opportunity. The other half of your question, I got too excited answering the first half.
The occupancy rate.
Occupancy, yes, no wonder I tried to avoid that one. The current vacancy rate is about 9.5%. Of that, half of that empty space is under refurbishment, so it'll be a better quality property when we have completed that refurbishment. About 10% of that is, and these are broad numbers now, is under offer at the moment to let. So we are squeezing the vacancy out of the portfolio slowly. But you would expect a turnover level of vacancy to be around about 5%.
Okay. Gentleman here, please. Thank you.
Thank you. As a REIT, are you limited to the amount of borrowing that you can do? And if you could borrow more, are there opportunities to invest the money and still get the same sort of yield as you're looking for?
We are not limited, but we've set ourselves a target of 25% gearing. And we're at 27.4 today, so that's sort of broadly around the target. Would we borrow more? 5 years ago, it would have been very attractive, wouldn't it? But today, with the cost of debt, you need a cost of debt for if you're borrowing against real estate, it's probably 5 3/4, 6% all in. So you need properties that are yielding more than that to be accretive, and the market is quite finely priced. I mean, I would say that we saw a big correction in the market from the autumn of last year, and I would say for the first time in a number of cycles of the property market, the market reacted in a very logical fashion to what had happened. I think it's corrected against the new cost of debt very accurately, and I think by and large properties are fairly well priced. But there aren't a huge number of opportunities. Given that we haven't got any spare equity at the moment, we would be funding them with 100% debt that would really drive the sort of returns we're looking for. And as a result of that, we are actually, rather than trying to find mispriced assets in the market to drive value, we're investing in the portfolio. I think we say it here, we've got 28 million of refurbishment and reinvestment identified across 23 projects that we expect to deliver a £10 million profit across the whole. So we think there's more value to investing in the portfolio than buying mispriced assets.
A question here, please. Thank you.
I didn't catch the geographic spread of your properties.
It's from Aberdeen to Plymouth and from Chester to Norwich. So the whole UK, but outside the M25 typically.
A question at the back here, please. No? Sorry, Peter?
Thank you. Very interesting talk. You mentioned that we shouldn't focus on the NAV, but the problem I have is that if the NAV goes down, we ignore it. An external foreign buyer may be interested and offer an unrealistic price but better than NAV. How do you prevent a takeover or a sale when you're not expecting it? And secondly, NAV is important perhaps because you're doing £28 million of refurb. Is the dividend cover 102%, including that refurbishment work?
The forecast dividend will be covered. The forecast is that will be covered, allowing for that refurbishment work. You're absolutely right. Around corporate activity, net asset value is important. And we have seen a little bit of corporate activity in the real estate investment trust world recently, with industrials being taken private by Blackstone and Civitas being taken out at below NAV. Clearly the board didn't think they were going to get to NAV. And so those trusts that are trading at deep discounts, and there are a number of real estate investment trusts trading at sort of 20, 30 discounts, and actually Columbia Threadneedle Property Trust have announced they're going to merge with London Metric. Those at deep discounts are exposed to corporate activity. We're at, varies day to day, sort of 5 to 10% discount to net asset value. So we don't feel as exposed as others. But on that point, you're absolutely right. But as a long-term investor, I would say that net asset value comes and goes. It's what someone else thinks it's worth. And the dividend yield, or the earnings yield better still, I think is a much better metric.
I get that, but the point is that the price at which the private investor invests is really important then, because if a corporate activity, merger, demerger, whatever happens, if I buy at whatever it is today and they just offer 2% more, it's not really going to be worthwhile.
Well, as long as it's more, that's good, isn't it?
It's relative according to the risk.
Yeah. Well, more is still more.
Any other questions for Richard? Otherwise, I just had a quick one. You described the office refurbishments and the higher demands for extra services or higher quality spec offices. Where do you see those? Are they in the city centres? Are they on the outskirts? Are they London South East, or is it across the UK?
It's across the UK, but it's city centres. So people don't only want high amenity from their buildings, they want high amenity from their locations. So good transport links, core city centres, outside London, it is Bristol, Manchester, Leeds, Birmingham, Edinburgh, Glasgow, core city centres, really strong amenity in and around the office building. Because if you are some people are being mandated back to the office, and some people are losing staff on the back of that. So I think you need a combination of stick and carrot. You need a little bit of saying to people who really do want you back in the office, but you've also got to make it a more attractive place to work than working from home. And to do that, immediately within the building, but also something to do at lunchtime. You can go out to lunch, you can do some shopping, drop off the dry cleaning. Everyone's got a life to lead, and they've found it much easier to lead while working from home. So if you take away all that ease and convenience by bringing them back to the office and offer them nothing back, then people will move. So core city centres, good transport links. And, people are moving back into the cities after the exodus to the shires and the coast during COVID.
Time's up. Richard, thank you very much indeed. Thank you, everyone, for joining us tonight.